Hello, everyone. Today, I'm thrilled to share insights into the foundational principles of Warren Buffett, one of the world's most exceptional investors. I hope they serve as a source of inspiration that you can integrate into your financial journey. Stay tuned until the end, as the last principle is a potent strategy that has been the secret arsenal of countless successful investors. Let's dive into it. Value investing. A cornerstone of Warren Buffett's investment philosophy is a strategic approach that focuses on identifying and purchasing stocks that are traded for less than their intrinsic or true value. Buffett, a staunch proponent of this methodology, meticulously assesses a company's fundamentals, management quality, and potential for growth to ascertain its actual worth. He seeks opportunities where the market price of a stock is significantly lower than its calculated intrinsic value, providing a margin of safety for the investment. This approach allows him to buy stocks at a discount, holding them for the long term and waiting for the market to recognize and correct the undervaluation. Buffett's mastery of value investing principles has been instrumental in his extraordinary investment success, enabling him to build wealth consistently over decades. Here's another amazing principle. Warren Buffett's investment philosophy is deeply rooted in long-term strategies, embodying a commitment to holding stocks for extended periods to realize substantial appreciation in value. He staunchly believes in the power of compounding and the ability of good companies to generate enduring value over time. Rather than succumbing to the market's short-term fluctuations and noise, Buffett's approach involves meticulous selection of stocks with a durable competitive advantage and the potential for sustained growth. His long-term holding strategy allows investments the necessary time to overcome temporary market downturns and uncertainties, fostering the realization of their intrinsic value. Consider this. If you had invested $1,000 on August 11, 2012, and allowed your investment a decade to flourish, it would have grown to approximately 145,341 by August 10, 2022. This represents a remarkable 145-fold increase in profit over 10 years. Now let's magnify this scenario. Imagine if you had been more ambitious and invested $10,000 at that same moment in time. Astonishingly, you would have crossed the threshold into millionaire status just after a decade. This hypothetical scenario illustrates the transformative power of strategic, long-term investment, showcasing the potential to escalate initial capital exponentially over time. Now let's move up to diversification. Warren Buffett's investment strategy includes diversification, but not in the conventional sense of the term. While many investors spread their investments thinly across a wide array of sectors to mitigate risks, Buffett chooses a more concentrated diversification approach. His portfolio is diversified across various sectors, but he invests significantly in businesses he comprehensively understands and believes have a durable competitive advantage. Buffett's style of diversification involves holding a select number of high-conviction investments in multiple sectors, allowing him to manage risks while also taking advantage of various market opportunities. This approach ensures that his investments are not overly exposed to the fortunes of a single sector, providing a balance that can withstand market volatilities and sector-specific downturns. It also allows for benefiting from growth opportunities in different parts of the economy, contributing to the robust and resilient performance of his investment portfolio. So what's next on our list? Warren Buffett is renowned for his frugal lifestyle, a personal trait that has significantly contributed to his immense wealth accumulation. Despite his billionaire status, Buffett opts for simplicity and cost-effectiveness in his personal expenditures, residing in the same house he purchased in the 1950s and maintaining a modest approach to spending. For 6 decades, Buffett has lived in the same residence in the central Dundee neighborhood of Omaha, Nebraska. The Oracle of Omaha purchased the home for $31,500, which would be worth about $250,000 in today's dollars. This frugality allows Buffett to save a substantial portion of his income, which can then be reinvested to generate further wealth. By prioritizing value and necessity over extravagance, he maximizes his financial resources available for investment opportunities. Buffett's frugality exemplifies his broader investment philosophy, emphasizing value, sustainability, and long-term growth. His lifestyle reflects a disciplined approach to wealth management, underscoring the significance of saving and prudent spending in building and preserving wealth. This approach has been instrumental in allowing Buffett to capitalize on investment opportunities and achieve compounded growth over time. Moving up next, Warren Buffett's investment strategy is profoundly centered on investing in quality businesses that exhibit a durable competitive advantage and are steered by competent and ethical management. He meticulously evaluates a company's business model, market position, and competitive moats such as brand strength, cost advantages, network effects, or regulatory advantages, ensuring that the business can sustain its profitability over the long term against competitors and market fluctuations. Furthermore, Buffett places significant emphasis on the quality of management, assessing their capability, integrity, and ability to steer the company towards continuous growth and innovation. He believes that strong leadership is instrumental in navigating business challenges, making strategic decisions, and ensuring the company's resilience and adaptability in a changing market landscape. Investing in quality businesses with robust competitive moats and exceptional management allows Buffett to hold investments for the long term, confident in their ability to generate consistent earnings, navigate market volatilities, and contribute positively to the portfolio's overall performance. Another crucial principle is compounding. Warren Buffett attributes a significant part of his investment success to the power of compounding, often referred to as the eighth wonder of the world. He understands that reinvesting profits can lead to exponential growth over time, as earnings generate their own earnings. Buffett's approach involves investing in businesses that can continuously reinvest earnings at high rates of return, thereby amplifying wealth creation. He prefers companies that retain and reinvest profits to fuel future growth rather than those that pay out large dividends, as reinvestment can lead to a multiplication of wealth over the long term. By holding investments for extended periods, Buffett allows compounding to work its magic, enabling small, reinvested earnings to snowball into substantial sums. This strategy, coupled with his long-term investment horizon, has been instrumental in Buffett's ability to accumulate extraordinary wealth and build Berkshire Hathaway into a powerhouse of value creation. Ramit Sethi, in his book I Will Teach You to Be Rich, illustrates the concept of opportunity cost and the power of compounding through a simple daily expense. Buying a $3 coffee every workday. He explains that while the direct cost of this habit over 30 years is $23,400, the opportunity cost is much higher, nearly $95,000. Sethi emphasizes that if the same threes per day were invested with an average return of 8%, it would grow to about $95,000 over 3 decades. This example underscores the significance of mindful spending and the potential of small, consistent investments to accumulate substantial wealth over time due to the compounding effect. Warren Buffett also values companies that possess a strong economic moat, which refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. An economic moat acts as a protective barrier, safeguarding the company against competitive forces in its industry. Buffett seeks companies with attributes such as brand strength, cost advantages, network effects, regulatory advantages, or patented technologies, which enable the business to fend off competitors and sustain profitability over time. These competitive advantages allow the company to generate excess returns on capital, maintain pricing power, and retain customer loyalty, ensuring the longevity and resilience of the business. Investing in companies with robust economic moats aligns with Buffett's long-term investment philosophy, as these businesses are better positioned to navigate market challenges, adapt to changing industry dynamics, and continue to thrive and generate value for shareholders over extended periods. Why you should invest in something you understand. Warren Buffett adheres to the principle of investing within his circle of competence, ensuring that he invests in businesses he thoroughly understands. This approach allows him to make informed and rational investment decisions based on a deep knowledge of the business, its industry, competitive landscape, and growth prospects. By focusing on sectors and companies where he has substantial expertise, Buffett can accurately assess the intrinsic value of a business, identify risks, and gauge the sustainability of its competitive advantages. Buffett's insistence on understanding a business before investing helps avoid mistakes attributed to lack of knowledge or misunderstanding of industry dynamics. It allows him to maintain conviction in his investment choices, even during market volatility, and to hold investments with a long-term perspective, capitalizing on their true earning potential. This disciplined approach to staying within areas of expertise has been a cornerstone of Buffett's investment success, enabling him to build a portfolio of high-conviction investments that have driven substantial returns over time. Many investors often allocate their funds to assets that are outside of their realm of understanding or expertise. This lack of knowledge can lead to feelings of panic and result in losses when market conditions don't align with their expectations. To make informed and resilient investment decisions, it's crucial not only to have a comprehensive understanding of the specific sector in which one is investing, but also to maintain a long-term perspective. Additionally, a broader awareness of the overall economic landscape is essential, as it significantly influences the performance of investments. By incorporating these elements, investors can navigate the complexities of the market with a more strategic and confident approach, enhancing the likelihood of achieving sustainable investment success. This final insight is genuinely transformative and has the potential to revolutionize your approach. Warren Buffett's investment success is significantly attributed to his patient and disciplined approach. He meticulously analyzes investment opportunities, waiting patiently for the right ones that align with his value investing principles. Buffett doesn't rush into investments. Instead, he waits for opportunities where he can invest at a price below the intrinsic value, providing a margin of safety. Buffett avoids being swayed by market trends, hype, or speculative bubbles. He maintains his focus on the fundamental analysis of companies, ensuring that his investment decisions are grounded in solid business performance and value rather than short-term market movements. This disciplined approach prevents impulsive investment decisions that are often driven by market noise or emotional reactions. Buffett's patience allows him to capitalize on market inefficiencies and invest in quality businesses at attractive valuations, holding them for the long term to realize their full growth potential. Warren Buffett is one of the most successful investors ever. But the Oracle of Omaha didn't get there overnight. In fact, about 99% of his wealth was created after his 50th birthday. His ability to remain steadfast in his investment principles amidst market volatility has been a hallmark of his successful investment career. Thank you for watching. Please don't forget to subscribe and turn the notification bell to stay updated with our content. Have a wonderful time. I will see you in the next video.